Jubilee Horizons, bridging strategy and success.
This presentation will provide a comprehensive overview of Shell Pilipinas Corporation. As you can see from our table of contents, we will cover the key areas including company information, business description, which includes value creation, business model, and strategic direction. Next, industry overview and competition, financial highlights, 5-year forecast, risks and opportunities, macroeconomic overview, environmental, social, and corporate governance, appendix, and recommendation.
Shell Pilipinas Corporation has been powering Filipino progress for more than a century. Its story began in the early 1900s when Shell first entered the Philippine market, introducing innovative fuels and lubricants that helped drive mobility and economic development. Through the decades, Shell expanded its operations from refining and distribution to retail, aviation, and marine services. In 2015, Shell Pilipinas reached a new milestone by becoming a publicly listed company under the Philippine Stock Exchange. Today, it remains part of the global Shell brand, recognized for innovation, safety, and sustainability. Shell's mission is to power progress together with the Filipino by providing more and cleaner energy solutions. Its vision is to be a world-class investment and trusted partner in nation building, creating shared value for society. At the heart of Shell's corporate culture are its core values: honesty, integrity, and respect for people. These guide every business decision and relationship with customers, partners, and communities. The company also upholds its business principles, focusing on economic competition, business integrity, political transparency, and the highest standards in health, safety, and environmental protection. In terms of business strategy, Shell Pilipinas aims to regain control earnings and solid dividend-paying position, continue as a major player in energy sector, and elevate industry standards while advancing the national energy transition.
Now, let's take a quick look at the business overview of Philippine Shell Petroleum Corporation. The company operates under three key business segments: mobility, which contributes about 55% of revenues through its retail network and convenience services; commercial business, which accounts for 35%, supplying fuels and lubricants to industries such as aviation, marine, and construction; and supply and distribution at 10%, which secures product availability to terminals, depots, and logistics operations. Shell's footprint covers Luzon, Visayas, and Mindanao with 1,179 mobility stations as of 2023. Its portfolio includes fuel-safe diesel, fuel oil plus, bitumen, lubricants, and aviation fuels. Digitalization remains a growth driver with over 2 million active users on Shell Go Plus, enhancing customer loyalty and brand engagement. Now, the heart of Shell Pilipinas operations lies in its business model canvas. Let's begin with the key partners. Shell's partnerships span across global fuel suppliers, logistic providers, government regulators, and technology innovators. These relationships ensure consistent fuel quality, efficient distribution, and regulatory compliance, essential in an industry where reliability and safety define market leadership. Moving to key activities, Shell's operations revolve around fuel importation and distribution, retail management, lubricants marketing, and sustainability programs. These activities support Shell's goals of providing cleaner energy while maintaining operational excellence across all channels. Next, key resources. Shell leverages a robust network of terminals, depots, and over 1,000 service stations. Its advanced digital systems, skilled workforce, and strong brand equity form the foundation of its competitive advantage. This infrastructure allows Shell to maintain market leadership even in volatile fuel environments. For the value proposition, Shell's strength is in delivering high-quality and reliable energy solutions supported by safety, innovation, and convenience. It offers both traditional and cleaner energy options, allowing Filipino consumers and industries to transition smoothly toward sustainability without sacrificing performance. Customer relationships are sustained through trust and engagement. Shell invests heavily in after-sales support, loyalty programs, and community partnerships initiatives that reinforce long-term customer retention. On channels, Shell reaches its market through its nationwide network of retail stations, direct sales to industrial clients, and digital platforms such as Shell Go Plus and Shell Advantage Rewards. These channels create an integrated ecosystem connecting physical presence with digital engagement. Customer segments include retail motorists, transport and logistic operators, commercial industrial firms, and government institutions. This diversified base ensures stable demand even during sectoral downturns. In terms of cost structure, major expenses involve fuel procurement, terminal operations, logistics, marketing, and CSR investments. Shell's scale enables it to optimize costs while maintaining premium product quality. Lastly, revenue streams come primarily from fuel and lubricant sales, franchise fees, industrial supply contracts, and digital service income. Emerging streams now include renewable energy projects and carbon offset initiatives, reflecting the company's transition toward a lower carbon business model. Overall, the business model canvas reflects Shell's balance between commercial profitability and its sustainability agenda, creating long-term value for both shareholders and society. Finally, Shell's value creation model shows how these strategies translate into tangible outcomes. With 2.1 billion in capital investments and 900 million in operational savings, Shell achieved 1.3 billion in net income and 24.9 billion in total value generated in 2024. Its operations align with UN Sustainable Development Goals, focusing on net zero emissions, environmental stewardship, and community empowerment. Shell continues to prove that responsible business can drive both profitability and progress.
Our first main section is the industry overview and competition, where we'll explore the landscape of the Philippine oil market and Shell Pilipinas plays within it. This presentation provides an overview of Shell Pilipinas Corporation, focusing on its market position, financial performance, strategic direction, and corporate governance. The Philippine oil market is highly competitive and is led by three major players, or as they call it, the Big Three, which is Shell Pilipinas, Petron, and Chevron. According to the data, Shell Pilipinas holds an 18% market share. In 2024, the company demonstrated resilience, achieving a net income of 1.3 billion on gross sales of 249.8 billion. Driven by a strong demand, Shell Pilipinas is identified as a leading player in the downstream oil industry in the Philippines. Its leadership is attributed to its nationwide retail network, premium products, and a strong brand reputation. The company also leads through product innovation, digital customer solutions, and sustainability initiatives, which are part of its Powering Progress strategy. Globally, Shell is actively involved in carbon reduction, biofuels, and hydrogen development. Looking ahead, the company has clear strategic expansion projects outlined from 2022 to 2030. The focus is on asset growth and modernization. Key initiatives include completing the Darong import facility to strengthen nationwide distribution, upgrading terminals, and expanding its network of mobility stations. The company has a target of operating over 1,400 Shell mobility stations nationwide by 2030, with an increased annual capital expenditure of 3 to 4 billion for a long-term growth. These projects also include scaling up EV charging and solar integration across its network.
Let's move on to Shell Pilipinas financial highlights for the first half of 2025. We'll take a look at how the company performed in terms of profitability, financial position, and cash flows. Financial overview. For the first half of 2025, Shell recorded about 114 billion in net sales, down 9% from last year. Operating expenses went up slightly, while net income fell to 965 million from 1.75 billion in 2024. Retail fuels made up 45% of revenue, and free cash flow was strong at 5 billion, showing good cash discipline. On income performance, quarter on quarter, both sales and profits softened as demand and prices normalized. Net income dropped 45% year on year, with earnings per share at 0.60 pesos. Looking at the margins, gross margin held at 10%, EBIT margin at 3%, and profit margin at 1%. This reflects slimmer profitability, mainly due to global oil price movements and higher operating costs. On the financial condition under assets, total assets slipped around 2%, mainly from lower cash and inventory. Still, liquidity improved. Current ratio rose to 99% and the asset test ratio to 65%, return on assets steady at 1%. Under liabilities and equity, liabilities declined by about 4% due to reduced short-term loans. Debt ratio improved to 73%, debt to equity ratio to 2.47 times, and gearing ratio to 51%, signaling lower leverage. Under operating cash flow was a highlight, up to 59% to 9 billion. This lifted the operating cash flow ratio to 22% and free cash flow to 5 billion, showing strong operational efficiency. On the cash flow summary, investing and financing activities stayed stable, with cash ending at 2.4 billion. In summary, while profitability softened due to price volatility, Shell showed resilience through solid cash generation, reduced leverage, and consistent balance sheet strength. Next, let's look at Shell Pilipinas' audited financial highlights from 2020 to 2024. This gives us a broader perspective of how the company's performance evolved over the last 5 years, covering recovery, profitability, and balance sheet strength. Under the financial position, from 2020 to 2024, total assets grew steadily from 86 billion to 117 billion, a 35% increase over 5 years. Growth was driven by higher trade receivables and property investments. While 2024 saw slight dips in non-current assets, Shell maintained strong liquidity with current assets improving by 13% year-on-year, supporting by higher cash and prepayments. Under the liabilities and equity portion, liabilities slightly decreased by 1% in 2024, mainly from lower lease obligations and provisions. At the same time, equity grew 6%, reflecting stronger retained earnings and stable capital reserves. This points to a more balanced capital structure, gearing down but still maintaining solid leverage for operational flexibility. Under financial performance, net sales peaked in 2022 at 291 billion pesos before stabilizing at 243 billion pesos in 2024 due to lower global oil prices. Despite this slowdown, Shell's net income improved to 1.25 billion pesos, recovering from the pandemic losses in 2020. Earnings per share rose to 0.77 pesos, signaling sustained profitability momentum. Under its operating cash flows from this reached 7.5 billion in 2024, up by 75% year-on-year. This increase highlights better working capital management and strong cash generation despite softer earnings. In the investing and financing side, investing outflows decreased as capital expenditures normalized, while financing activities posted a 4 billion outflow, reflecting active debt repayments. Year-end cash climbed to 2.96 billion, more than triple since 2020. Profitability ratio stabilized post-pandemic. Net profit margin remained around 1%, while gross margin held at 9 to 10%. Liquidity stayed healthy, while the current ratio averaging 85 to 90%, and solvency improved as debt to equity dropped from 3.9 times to 3.7 times, indicating stronger capital efficiency. Efficiency-wise, inventory and asset turnover remained steady, while valuation metrics improved. Earnings per share is up to 0.77 pesos and book value per share at 19 pesos. The price to earnings ratio closed at 9.7 times, suggesting the stock remains fairly valued relative to its fundamentals. To summarize, Shell Pilipinas delivered steady recovery and operational discipline from 2020 to 2024, marked by stronger cash flows, improving equity and controlled leverage. While 2024 earnings softened versus 2022, its fundamentals remain intact. Given its stable balance sheet and consistent cash generation, the outlook looks positive, supporting an initial hold position with a buy bias once profitability accelerates and oil prices stabilizes. Now, let's move to the 5-year financial forecast of Shell Pilipinas from 2025 to 2029. Here, we translate our assumptions and projections into a forward-looking view of Shell's growth, margins, and valuation. Our model is based on a cost-loss approach and CAGR benchmarking. We consider data from the BSP, DOE, and PSA, integrating oil price movements, forex impact, and inflation trends. Operating costs are expected to grow 3.2%, while cost of sales moves around 8.1%, mainly tied to fuel import prices and exchange rate exposure. Cost pressure remains a key driver. Roughly 80% of sales are forex sensitive, so volatility in the peso or oil prices can easily swing margins. But Shell's ongoing investments in mobility and energy transition infrastructure can help cushion those risks over the long run. We forecast 8% annual sales growth, stabilizing after the post-pandemic recovery. Margins are seen normalizing, gross margin at 9% and EBIT margin at 3%, consistent with industry averages. The company stays efficient but still operates in a tight margin business. Net income is projected to grow from 1.7 billion in 2025 to 2.35 billion by 2029, or roughly 6% CAGR. Assets will rise to 176 billion pesos, backed by a stronger equity base, a sign that Shell is growing without relying heavily on new debt. Shell remains financially sound, debt ratio at 74%, interest coverage at 3.7 times, and return on equity steady at 11%. These numbers mean that the company is managing leverage effectively while keeping returns consistent, not explosive but stable.
Like any major energy company, Shell Pilipinas faces both challenges and opportunities in the dynamic market environment. One key risk is the declining demand for traditional fuels due to the growing adoption of electric vehicles. In 2024 alone, EV sales in the Philippines increased by 25%, and projections show around 2.4 million EVs by 2028. Instead of resisting change, Shell sees this as an opportunity by investing in EV charging infrastructure, a market expected to grow more than 20% annually over the next decade. Another major risk is oil price volatility. In the first half of 2025, the company reported a 44.7% drop in earnings due to global oil price fluctuations and decreased sales. Geopolitical tensions, including conflicts in oil producing regions like the Middle East, continue to affect global supply and pricing. In addition, macroeconomic pressures such as the US tariffs on the Philippine export can indirectly affect consumer spending and fuel demand. Despite these risks, Shell Pilipinas is capitalizing on renewable energy opportunities, investing in solar projects, battery swapping technologies, and electric mobility solutions. Its shifts from traditional refining, highlighted by the Tabangao refinery conversion into an import terminal, demonstrates agility and readiness to lead the energy transition.
We'll begin with a quick look at the macroeconomic view that sets the stage of our market performance. This presentation will cover the opportunities and headwinds we're facing in the Philippines energy sector. The Philippines economy is poised to sustain its growth momentum even amidst global headwinds. This is supported by several strong indicators. First, the country is the second fastest growing economy in the Southeast Asia. Our GDP is set to grow throughout 2028. Second, the Philippines benefits from a young, growing population with a median age of only 24.5 years, which should continue to provide a strong working age population for the next 40 years. Finally, the government's infrastructure push is massive, with 174 projects worth 8.3 trillion running from 2023 to 2028. The tourism sector is also expected to grow significantly, with a 14% annual growth rate from 2025 to 2028. Looking at the specific financial indicators, inflation ended 2024 at 3.2% and is projected to remain at 3.2% in 2025. This is within the government's 2% to 4% target. The Bangko Sentral ng Pilipinas is projected to cut interest rates by 50 basis points in 2025, bringing the rate to 5.25%. This follows an overall 75 basis point rate cut in 2024. The Philippine peso is expected to fluctuate, but is projected to end 2025 in the range of 58 to 61 against the US dollar. Globally, we've seen fuel prices trending downwards due to a stronger US dollar and weaker demand. While the Philippine economy grew despite a weaker peso, the financial year 2024 GDP growth of 5.6% fell short of the government's target. Now, shifting to our industry, petroleum demand is expected to sustain growth. Key drivers here include vehicle sales, which are expected to surpass 2 million units in 2025, and robust growth in industrial sectors like power, manufacturing, and mining. However, we operate in a hyper competitive market. Shell is the second leading player in the downstream oil industry. The number of fuel retail outlets has grown exponentially since 2017. The Visayas and Mindanao regions, in particular, saw huge growth with 120% and 114% increases in outlets, respectively, from financial year 2017 to 9 months of 2024. Furthermore, import terminals in the Philippines have soared, nearly doubling from 25 in 2019 to about 45 in 2025. This combination of a rising demand and increased competition highlights the need for strategic focus. This concludes our macroeconomic and industry overview.
Shell Pilipinas continues to strengthen its sustainability agenda through robust environmental, social, and governance initiatives. On the environmental front, Shell is working toward net zero emissions by 2050, investing in low carbon technologies, expanding EV charging networks, and supporting biodiversity and water management programs to minimize its ecological footprint. Socially, the Filipina Shell Foundation Incorporated, or PSFI, serves as the company's social arm. For over 40 years, PSFI has empowered Filipino communities through programs focused on livelihood, education, health, and disaster resilience. From helping micro-entrepreneurs to training young professionals, the foundation embodies Shell's commitment to nation building. In terms of people management, Shell promotes diversity, inclusion, and continuous learning. Employees are empowered to innovate, lead responsibly, and uphold Shell's values of integrity and respect for people.
In terms of corporate structure, the document details the composition of the board of directors. The company follows a policy on board diversity promoting a range of backgrounds in gender, age, skills, and knowledge to ensure independent judgment and sound corporate strategies. The document provides detailed profiles of each board member, highlighting their extensive experience in fields such as engineering, finance, management, and risk management. Profiles of Chairman Min Yi Tan and CEO Laurelie Q. Saya, along with independent directors Cesar Buenaventura and Lydia Echoes, they bring expertise in engineering, finance, and general management. Features independent directors Fernando Zobel de Ayala, a corporate leader, Nina de Aguas, a top executive in the insurance industry, and Amando M. Tetanco Jr., a former central bank governor. Profiles for directors: Chief Financial Officer Reynaldo P. Abilo, Insurance Expert Randolph T. Del Valle, Retail Operation Expert Luis C. Lacchio, and Risk Management Specialist Stuart Shoplin. Details the final board members: Edgar Ochua and Michael P. Ramolete. And lastly, the document details shown the stockholding of its directors and officers, showing their ownership and direct investment in the company.
To wrap up, Shell Pilipinas is moving in the right direction: steady growth, healthy cash flows, and improving capital structure. At the implied price of 22.90 per share by 2029, the stock looks fairly valued, not cheap but not overbought either. Given stable fundamentals and manageable risk, our stance is a confident hold with a buy bias once we see margin expansion or stronger volume growth. Overall, Shell shows resilience and discipline, and that supports our conviction in its long-term sustainability.